Welcome to Money is Freedom, a podcast exploring how finance and freedom connect in our lives. Created from thoughtful research and narrated by Notebook LM AI, this series brings you clear, meaningful insights into finance and beyond.
Welcome to episode 39. Today, we're diving into something that doesn't happen often. The bond market is acting up, and it's rattling more than just Wall Street. It even spooked Donald Trump, forcing a pause on some of his tariff plans. Let's break it all down.
You know, we all try to keep tabs on our finances, right? Checking investments, planning ahead, or just figuring out what's going on with the economy.
Absolutely.
And lately, there's been some really, well, let's say interesting activity, maybe even a little weird, in the bond market.
Yeah, the bond market doesn't always grab headlines, but its impact is huge.
Yeah. Right.
Massive.
Exactly. So for this deep dive, we pulled together some pretty compelling stuff. We've got this social media post, pointing out how a past trend seems to have just flipped. Plus some text that goes deeper on that, some audio commentary from someone who really tracks this stuff, and then a bunch of news articles from today, April 11th, 2025, all zeroing in on this strange bond behavior.
Right.
So our goal today is pretty straightforward.
Right.
Let's try to unpack why the bond market is acting so well unexpectedly and what it might be signaling for the bigger picture, for all of us.
Yeah, absolutely. And the core question really is, what do these recent moves actually mean? Is it just a blip or something deeper? Especially when you look at history, how bonds usually acted, and compare it to current economic policies.
And that social media post you mentioned really hit on something key, didn't it?
It did. The whole flight to quality thing. For like 20 years, when stocks got rocky, people piled into long-term U.S. treasuries.
Yeah.
Safety.
Yeah, the safe harbor.
But that post points out, that's just not happening this time. It's absent.
Okay, let's dig into that shift then. That post had a chart, right, showing the 30-year bond yield against stock market stress periods.
Yeah, and it was pretty clear. You saw those green boxes, Brexit, COVID.
I remember seeing those.
During those big scares, you saw yields go down, meaning money was flowing into those long bonds, a counter-trend move, like they called it.
But now?
Now it's the opposite, or, well, it's just not happening that way, which ties right into that audio commentary we looked at.
What did the commentary add?
Well, the speaker specifically remembered past crises like Lehman Brothers or that initial COVID shock. And back then, he said, the gains you made in bonds helped offset the losses in stocks, like a cushion.
Ah, okay, so it softened the blow.
Exactly. He even put numbers on it, said something like $8 trillion lost in Lehman, but maybe $3.5 trillion recouped in bonds,
Right.
and $9 trillion lost in COVID stocks, but about $4 trillion recouped in bonds. That's a significant buffer.
Yeah, no kidding. So that classic 60-40 portfolio, 60% stocks, 40% bonds,
Yeah.
it wouldn't get totally crushed because the 40% did its job.
Precisely. But the audio commentary hammered this point. Right now, people have lost, maybe $9 trillion in their 401ks since the highs.
Yeah, a huge number.
But that offsetting gain from bonds, it's just not there this time, not materializing.
So why not? Why are bonds falling too?
Well, the audio pointed out yields have been rising pretty steadily since December. And remember, yields up means prices down.
Right, inverse relationship. Always got to remember that.
So if you're holding bonds, their value is shrinking at the same time your stocks are getting hit.
Ouch, that's the double whammy.
That's exactly it. So the wealth destruction for someone with that kind of balanced portfolio is, much worse than in the past. The safety net seems gone.
And the commentaries, this isn't brand new, right? This started before just the last few weeks.
Yeah, that was a key point. This decoupling, this break between stocks and bonds, it really started back in 2022, and it seems to be continuing.
Okay, so that suggests something fundamental has shifted. What's driving it? What's the main theory?
Well, according to that audio commentary, a huge factor is massive federal deficit spending.
The deficit again.
Yeah. The numbers are pretty staggering. The speaker mentioned $11 trillion since 2020.
11 trillion.
Yeah. And running at about $2.6 trillion a year right now, which, as one of the texts pointed out, is like 9% of GDP.
9% of the entire economy, just in deficit spending. That's enormous.
It really is. An enormous amount of government borrowing.
Okay, so connect the dots for me. How does all that borrowing mess up the bond market like this?
The argument is basically this. The government keeps issuing more and more debt. Plus, they have to refinance a lot of existing debt this year.
Okay.
So if you're an investor, Why would you want to buy, say, a 30-year Treasury bond? Lock your money up for decades.
Especially if it hasn't been a safe haven lately.
Exactly. And if the government is just going to keep flooding the market with more bonds.
Correct. That could push prices down even further or keep
Yeah.
yields high.
Right. So the audio suggested investors are kind of waking up to this. They're getting more hesitant about buying those long-term bonds.
That makes a certain intuitive sense.
Yeah.
If you're worried about inflation down the road or just the sheer volume of debt, maybe a long-term bond at current yields isn't that appealing. And less demand means lower prices, higher yields. It sort of feeds on itself, doesn't it?
It can, yeah, which worsens the whole situation.
Okay, so deficit spending is a big piece. What about the international angle and this idea of bond vigilantes? The news articles were talking about that.
Yeah, that really came through in the news. CNN Business reported this sell-off happening in both stocks and treasuries at the same time.
Which is unusual.
Very unusual. And the trigger seemed to be worries about President Trump's tariff plans and maybe a trade war with China heating up again.
Right, because normally uncertainty like that makes people run to treasuries, the flight to safety.
Exactly. So seeing both go down together, that's unsettling. The article said it's usually linked to really extreme uncertainty, like the pandemic or the 2008 crisis.
So what are these bond vigilantes then?
It's a term for investors, basically, who protest government policies they don't like
How do they protest?
by selling government bonds or just refusing to buy new ones.
And that does what? Drives prices down.
Exactly. Less demand, lower prices, which means higher yields.
Which makes it more expensive for the government to borrow money.
Precisely. It's the market essentially disciplining the government, sending a message.
Like that James Carville quote CNN mentioned about wanting to be reincarnated as the bond market so you can intimidate everybody.
Yeah, that quote captures the power, doesn't it? The potential power, anyway.
And the article suggested it actually worked this time, that the market reaction made Trump reconsider the tariffs.
Seems like it might have. Both CNN and CNBC reported the bond market's negative reaction was a big reason he decided to delay some tariffs.
Wow. So the market spoke and policy changed. That's pretty direct.
That's a clear example, yeah.
What else did the banks like UBS and Deutsche Bank say in that CNN piece?
Well, UBS had a more maybe technical take, investors selling bonds just to raise cash to cover stock losses.
Okay, plausible.
But Deutsche Bank raised a, frankly, more worrying question. They wondered aloud if U.S. government bonds are actually losing their status as the ultimate safe haven.
Whoa. That ties right back to our main theme, doesn't it?
Directly. If a major bank is questioning that status, that's significant.
Definitely. Now, how do international investors and tariffs fit into this bond selling?
Well, CNN suggested foreign investors might sell treasuries as a sort of negotiating tactic against tariffs, like, you tariff us, we sell your debt.
Bit of financial hardball.
Could be also just mechanically, if the U.S. imports less because of tariffs, fewer U.S. dollars end up overseas.
Right.
Which means foreign investors have fewer dollars to then turn around and buy U.S. Treasury bonds with. Less capacity, maybe less desire.
Makes sense. Less trade, fewer dollars flowing back into U.S. debt. And this links to that point in one text about China, right?
Right.
Trading more with other countries.
Exactly. That text pointed out China's now the top trade partner for like 140 countries, so maybe they're less reliant on selling to the U.S.
And less reliant on buying U.S. bonds with those dollars.
That was the argument. The old pattern was sell stuff to the U.S., buy U.S. bonds, the bond games.
Yeah.
The shift might be towards sell stuff to the U.S., use the dollars to buy stuff from wherever, maybe even from the U.S., but buying goods, not just bonds.
Reducing the need to just park the cash in treasuries.
Yeah. And there was that other kind of pointed suggestion in one excerpt.
About the U.S. potentially using tariffs if countries don't buy U.S. goods.
Yes, that tit-for-tat idea. If they don't buy enough U.S. stuff, maybe tariffs equal to that value get imposed, which would stir things up even more, obviously.
Yeah, more trade disruption, more bond market ripples potentially.
And that excerpt also made that sort of cynical point about the U.S. paying interest for years on bonds that bought goods that wear out quickly.
Okay, so it's this really complex mix. Deficits, trade wars, changing global dynamics, investor psychology, all hitting the bond market.
Pretty much, yeah.
So what were the immediate market signals? What did the news say happened like yesterday and the day before?
Okay, so both CNN and CNBC flagged a big jump in the 10-year Treasury yield. Got as high as 4.5% Wednesday, settled back just above 4.4% Thursday.
And 4.5% is pretty high compared to recent history, right?
And definitely noticeable. And again, high yield means lower bond price.
Oh, yeah.
But crucially, that 10-year yield is a benchmark.
Right, it affects everything. Mortgages.
Mortgages, car loans, business borrowing. Higher yields there mean higher costs for lots of people and companies.
Okay, so rising borrowing costs. What else? Did the dollar react?
It did. CNN mentioned the U.S. dollar index fell sharply, like 1.8% on Thursday.
And a falling dollar usually means?
Often seen as lower confidence in the U.S. economy or its assets relative to others.
Okay, so rising yields, falling dollar, not exactly confidence-boosting signal. How about stocks? Volatile.
Very volatile, yeah. CNBC said stocks rallied hard Wednesday when the tariff delay was announced.
A relief rally.
But then plunged again Thursday. So the underlying nervousness didn't just vanish.
And Bill Ackman chimed in.
Yeah, his comment was basically falling stocks, rising bond yields, falling dollar. That's not a recipe for success. Not what you want to see policy achieve.
No, that sounds like a pretty bad trifecta.
Sure.
Did other analysts have takes picked at asset management?
Their view, according to CNN, was that the administration's policies are actually damaging that idea of U.S. assets being a safe haven, echoing the Deutsche Bank concern again.
So multiple sources pointing to that potential erosion of safe haven status. What about ING?
ING's analysts basically said markets won't forget these wild swings quickly. It makes investors jumpy, more cautious, could have lingering effects.
In CNBC's headline, Trump dodged a disaster because the bond market reacted.
That sounds dramatic.
It does. Their point was the bond market's reaction was so strong they called it a scream that it forced the policy change on tariffs, potentially avoiding something worse.
Okay. Did they get into why the bond market reacted so violently? Beyond just the policy concerns?
Yeah, they mentioned some more technical stuff. The unwinding of basis swaps, trades.
Basis swaps.
Yeah.
Okay, what are those in simple terms?
Think of them almost like insurance contracts between different parts of the interest rate market.
Okay.
When one part moves really fast and unexpectedly, like treasury yield spiking, these insurance contracts can suddenly become very expensive for whoever bought the insurance, often hedge funds.
Right.
So to cover those sudden costs, they might be forced to sell other things they own quickly, like government bonds.
So forced selling, even if they don't want to sell, just to raise cash. Exactly. Which adds more selling pressure, pushes prices down, yields up. It amplifies the move.
I see. So it's not just about the big picture, but these internal market mechanics can make things worse. Did Janet Yellen comment on this?
Yeah, the former Treasury Secretary, CNBC quoted her pointing to highly leveraged hedge funds having to sell, adding to the instability. So reinforcing that idea about the basis swaps and forced selling.
And the deficit came up again in the CNBC piece too, right? It just keeps popping up.
Absolutely. They highlighted it's on track to top $2 trillion a year, which just adds to that background level of investor angst about U.S. fiscal health.
It's kind of a catch-22, isn't it?
Yeah.
CNBC also mentioned that lowering the trade deficit, which is usually seen as a good goal, could actually reduce demand for treasuries. How does that work?
It's that dollar flow thing again. Lower trade deficit means the U.S. is importing less, sending fewer dollars overseas.
Right.
Fewer dollars overseas means foreign buyers have fewer dollars to buy U.S. treasuries. So paradoxically, improving the trade balance might actually hurt demand for U.S. debt.
That's counterintuitive. And finally, they mentioned big holders like Japan and China trimming their treasury holdings.
Yeah, scaling back a bit. It's not necessarily a massive move in the grand scheme, but when the two biggest foreign holders are reducing exposure, even gradually.
It doesn't help confidence, especially when the U.S. needs to borrow so much.
Exactly. It's just another factor adding to the unease. CNBC finished by stressing just how huge the bond market is compared to stocks, underlining why these signals, these unusual moves, really matter.
Okay. So let's try to pull this all together. It really sounds like the bond market is sending some very different signals than usual, potentially quite significant ones.
Yeah, I think that's fair to say.
It's not playing that traditional safe haven role during stock market stress.
Not like it used to, no. And it seems to be this mix of factors colliding.
Right. The massive federal spending and the deficit, that's clearly a huge underlying issue. Investors are getting nervous about all that debt.
Definitely a major piece. But then you layer on the global trade stuff, the tariff tensions, the uncertainty.
Which spooks international investors and brings these bond vigilantes into the picture, maybe pushing back on policy.
Exactly. All these things seem to be interacting.
And we need to remember, this isn't just charts and numbers. Rising bond yields mean real costs go up. Mortgages, loans.
Absolutely. Real-world impact.
And the volatility hits people's retirement accounts, their investments. It affects financial security.
For sure. It's not just a Wall Street story. It matters for everyone trying to manage their money. So yeah, keeping an eye on the bond market seems pretty crucial right now.
Okay, so on that note, here's maybe a final thought to chew on. Could this weird behavior we're seeing, could it signal something really fundamental changing? Like, is the role of U.S. Treasuries as the ultimate safe asset actually being reshaped right now?
That's the big question, isn't it?
And if it is changing, what are the long-term consequences? Not just for our portfolios, but for the whole global economy.
Yeah, that's a profound thought. If that bedrock assumption starts to shift.
Definitely something complex, still unfolding. We definitely encourage everyone listening to maybe look back at some of these sources, keep exploring the themes, and form their own perspectives.